REITs, a trust designed specifically to own and operate income-generating real estate in a tax-efficient manner. In Singapore, these REITs can hold an array of property types, namely offices, retail, industrial, hospitality, healthcare-related, and data centers. Today we discuss the pros and cons of REIT investments, and we'll also touch on REIT sponsors. But first, let's talk about REITs with overseas assets. As at the recording of this video, there are 40 S-REITs listed on the Singapore Stock Exchange. A quarter of them hold multiple property types in their portfolio, and these are classified as diversified REITs. The largest by portfolio value is CapitaLand Integrated Commercial Trust at around $24.5 billion. In recent years, REITs have been expanding their portfolio abroad. Today, only 3 S-REITs are pure Singapore play. 17 S-REITs have only overseas properties, while the rest of the 20 have a mixture of local and overseas properties. Josh Liao of Elite UK REIT tells us about his REITs with overseas assets.
Well, a REIT is rather unique in that all assets are based in the UK. But not only is that different, our key tenant is also the UK government. We do derive almost close to 100% of our rentals from the UK government, and our leases are signed at the very top level, which is as sovereign as you can get in terms of credit from a tenant. The key challenge here is one of familiarity. I constantly have to educate people in this part of the world what our portfolio is used for. The key tenant that we have is the UK government. The portfolio that we have are used as job centres to deliver social services to the community at large in the UK. Elite UK REIT is also listed on the Singapore Exchange, but we are listed in sterling pounds. As such, we do have what we call a natural hedging in terms of the dividends that we pay, that's in sterling pounds, the debt that we take, that's in sterling pounds, and the rentals that we receive in sterling pounds, ensuring that the unit holders are not exposed to any currency risk. We do not have to hedge across foreign exchange. Currently, the UK just finished its general elections for 2024. The elections were called early, and there's a lot of optimism within the UK economy that the new Labour government would bring about key economic change and growth. For the rest of the year, there is a lot of discourse over the Bank of England eventually cutting its interest rates as inflation has come down to very recently below the 2% target. So that will bode well for our unit holders as well as the UK real estate market in general.
Today, REITs alone make up around 12% of the total market cap of SGX Listcos. Let's discuss the pros and cons of REIT investments. The pros: regular income streams. REITs are required to distribute at least 90% of the taxable income in the form of dividends to unit holders, providing a consistent income stream. Liquidity. Unlike direct real estate investments, publicly traded REITs can be bought and sold on major stock exchanges, offering greater liquidity. Diversification. Investing in REITs can diversify an investment portfolio, potentially reducing risk, as real estate often has a low correlation with other asset classes like stocks and bonds. Accessibility. REITs allow individual investors to invest in portfolios of real estate assets that they might not be able to purchase directly due to high capital requirements. Professional management. REITs are managed by professionals who handle all aspects of property management and development, reducing the burden on individual investors. Inflation hedging. Real estate often appreciates in value, and rental income may increase with inflation, making REITs a potential hedge against inflation. Tax transparency. For retail investors, there's no withholding tax on distributions from REITs, and REITs themselves do not have to pay tax so long as they distribute at least 90% of their distributable income. However, just like every other investment vehicle, REITs have their disadvantages. Interest rate sensitivity. REITs are generally sensitive to changes in interest rates. Rising interest rates can lead to high borrowing costs and can diminish the attractiveness of REITs dividends when compared to safer assets like bonds. Property market exposure. Economic downturns, decreasing property values, or a slump in the real estate market can adversely affect the performance of REITs. Management and transaction fees. REITs incur management fees and other expenses which can affect overall returns. Weak capital structure. A major attraction of REITs also gives rise to its weakness, the capital structure. Since REITs pay out at least 90% of their distributable income, they do not keep any retained earnings, which are a major source of strength in companies. This weakness in the capital structure puts REITs at risk should the valuations of its properties drop too much. The lack of retained earnings and cash was in full view during the collapse of Manulife US REIT when it went on a buying spree, following which prices tumbled and the stresses in the other two US office REITs. Paying out depreciation. The other weakness when REITs pay out most of their distributable income is the manner in which they pay out the depreciation. Properties suffer wear and tear, and REITs often undertake asset enhancement initiatives or AEIs for their properties. Many REITs, for example the CapitaLand Integrated Commercial Trust, withhold some distributions to use for their AEIs. Elsewhere, Mapletree Industrial Trust had its sponsor participate in its distribution reinvestment plan to preserve capital when it rebuilt Mapletree High-Tech Park at Kolam Ayer. The sponsor. The majority of S-REITs are supported by a sponsor. The sponsors usually provide the properties that are injected into the initial portfolio of the S-REITs around the time of its initial public offering, and may continue to provide a pipeline of assets to the S-REITs post-IPO. The sponsor also typically owns stakes in the REIT manager and the S-REITs.
The way to look at a REIT sponsor is like a parent nurturing a child. The REIT sponsor is one who initially spawns out some of the asset in their portfolio into the REIT for giving a stable dividend income for the investors. This gives you a stable dividend income over a longer period of time. So what does a sponsor's role play? Firstly, the sponsor develops the assets and then sponsors it into a REIT. They have a lot of operational experience that is transferred into this REIT. They also provide in times of need with capital for the REIT to grow. They also typically take a sizable stake in the REIT to demonstrate their interest and grow their portfolio along with the REIT.
REITs are capital-intensive vehicles, which means they have to borrow quite a lot and are reliant on refinancing. So you do want to be invested in a REIT that has a strong balance sheet, low borrowings, and hence the ability to refinance when its liabilities come due. What are signals of quality? These may include the types of assets that the REITs are invested in, who the sponsor is. If the sponsor is a large government-linked entity, it is more likely that banks will be willing to lend to the REIT to help it in terms of the refinancing. So that's the first order of business. Quality as defined by balance sheet, as defined by sponsor.
The other way sponsor helps also, the sponsor has a pipeline of assets. The way it works is that the sponsor builds, develops an assets, nurtures the assets, and then grows it to a point of stability with a stable cash flow, and then injects the assets into the REITs. So for a smaller REITs, it's typically very hard to go and compete in a market, in an open market to acquire an asset, especially in a market like Singapore, Hong Kong, Asian markets. The assets are very tightly held, and it is very difficult for a smaller REIT to go and purchase an asset from external market. That's when sponsor comes in handy. They give you with a ready pipeline of assets. They have grown these assets. We have seen sponsors like CapitaLand, Mapletree, etc., which have grown a lot of assets and then gives the asset as a sponsor pipeline to the REITs, so that when the time is right and when the REIT feels the time is right, they can buy the asset and grow the income portfolio for the investors.
So yes, it seems a strong sponsor does make for stronger REITs. Let's recap this episode. We briefly introduced S-REITs and its importance to the Singapore Exchange. We discussed the benefits and also shortcomings of REITs that investors like you and me should note. And we ended off with an assessment of how much attention we should pay to REITs sponsors. I hope you've taken with you a little more understanding of REITs investments. See you in the next one.